It is Wednesday, March 25th, 2020, and we're continuing to provide lots of value to our clients and our community for High Speed Alliance, and excited to have DJ Van Keuren on the call today. DJ, how are you?
I'm good, thank you. Thanks for having me on.
Yeah, absolutely, absolutely. So first off, that is a beautiful background. Why don't you tell everybody where you're live broadcasting from?
Yeah, so I'm in the studio in Denver, Colorado, and so we've got no snow. It's great outside. Of course, nobody's on the street as we went into lockdown probably about a couple days ago. But Denver, Colorado.
Now, you are, I believe, an avid skier. I know we were actually together in Breckenridge a few weeks ago. Appreciate the invite to come out and hang out. Yeah. And you get to put in how many days a year are you skiing?
Not enough. It's not enough, but I probably get in 5 or 6 days a season. Sort of like golf. I wish it was a lot more, but I work too much, I guess you could say. But it's great because we can go up and, it's only an hour to the first location, and then it's about 2 hours to anywhere else we want to go.
Yeah. Yeah. What's your favorite place to go?
It's Steamboat. Love going up to Steamboat.
Yeah. Very cool. Well, DJ, we are excited, hopefully, to have you live in Huntsville in a month or so. We'll see. Probably exactly a month. We will see if we're going to be live or if we're going to be virtual. We don't know yet due to the current coronavirus crisis. Yeah. So we're certainly fingers still crossed that we can do that, but we've got a backup plan. We've got contingency plan to go virtual. So they may get to see you again then.
Well, if we can't come out at that point in time, then we can look to reschedule and come back out at some other time.
Yeah, no, that'd be great. So wanted to just share a little bit of your background with the with our community. You've worked with some very cool families and got to do some really cool things. So why don't you talk a little bit about working with the Heyman office and the Giorgio Beverly Hills, and also with the Monfort family and the Colorado Rockies. Why don't you give us a little background on that?
Yeah, so I fell into working for a family about 6 years ago, I think it is now, and 95% of the people that work for a family, they fall into it, to be honest with you, and that's what happened with me. The first family was actually out of Boulder, Colorado, and the gentleman sold a yogurt company for $1 million, turned it into about $600 million, which was quite impressive. I then got headhunted by the Heyman family, founders of Giorgio Perfume, Giorgio Beverly Hills, and with them, my focus, as you know, is on the real estate component. Used to do a lot more with the portfolio, but that's where my passion is. So with the Heyman family, we came in, we looked at their real estate portfolio. The son had an exit as well, and so he created his own wealth, which doesn't typically happen.
No,
and so we ended up came up with a brand strategy. We sold off some of the properties. We got everything stabilized, brought somebody in, and so we finished up there. And then after that, it's been working with the Monfort family, and it's been the third gen. Usually 90% of the wealth is lost by the third generation. Mm-hmm. And so I'm working with the third gen right now. He's the only one that doesn't work for the Colorado Rockies baseball team. And the family initially made their money in the cattle industry. They actually created the feeder that is used for all the cattle. And then they bought the Colorado Rockies when they brought the franchise to Colorado. Incidentally, they paid $50 million. Obviously, it's worth a lot more today.
Wow.
But it's great. I absolutely love working with these families, and sorry about that.
That's okay.
And it's fascinating. It's great. It's a lot of the same issues that families run into as, people that might not be as wealthy. It's just really adding a zero in many regards. But a lot of the same issues that they have is the same thing as, everybody else when it comes to wealth, especially times like now. Just because it's unprecedented, but it's only going to be for a short term, which is great, but it's still something we've got to ride out.
Give us a little more detail on how to turn $1 million into $600 million.
Well, I'll tell you what.
How did that happen?
Well, he did everything in real estate is what he had done. And so his focus, which is one of the reasons I started working for him, is because I believe 100% of what his strategy was. It was secondary markets. So you're looking at places like a Denver, a Salt Lake. Well, Seattle's probably moving up the curve a little bit. Probably down in your neck of the woods, areas that are really having a lot of growth. A lot of the institutions, they won't go there. They'll want to stay in the major cities, San Francisco, LA. So he was going in these secondary markets, deals between really $10 to $40 million in size. And he'd focus on value add, would do some construction, but he was a contrarian investor. And, a lot of people either don't have the stomach for that or don't realize that that's a great place. They get worried, right? The same thing that Sam Zell did. Sam Zell was sitting at the table during the RTC, and he was asking, why is nobody else sitting around the table with me? Maybe I'm wrong. Yeah. So my patriarch would just continue to invest, and he would use the 1031 exchange. So last year he had probably about $250 million of just 1031 exchange money that would keep rolling over. So that's the one thing that he'd do. He'd be contrarian. He'd go ahead of the curve, smaller markets. I think the biggest thing outside of that, which I did really learn from him, is that he was the most analytical guy that I ever met. But he would say, if I can't get a 25% IRR, I won't even look at a deal. And so he stuck to that. In fact, he had a whole team that would support everything that was going on, looking for opportunities and stuff. And there was a $40 million transaction. And one of the guys that found the deal was just complaining. I'm like, what's wrong? He goes, there's only $100,000 difference. And, the patriarch won't budge. And I looked at him and I'm like, well, that's why he's worth so much, because if you got 24.9, I'm not going to do it. I've got to restructure this. And, you take out the emotion and you stick to your plan. And, in real estate, the biggest thing I've learned personally is that if you find the deal of a lifetime, you're going to find something as good, if not better, tomorrow. Yeah. So it's really him sticking to his guns with his philosophy, his due diligence, and, staying the course. And he sold 80% of his portfolio before the last downturn. So he's aware of that. Yeah. But and he's been building up cash. I mean, what we're seeing right now is I know a lot of people are concerned. Families are like, what's going on? It's primarily the stock market that you see, but this is the time that you really need to be ready. And this is going to be short-lived, because a lot of the fundamentals are going to remain the same, but this is the time that you can make a lot of money, and this will pass. It's not going to be like the last recession, but this is when the real money's made. And you have to keep that in mind.
I 100% agree with that. What was the asset type in real estate? Was he doing multifamily or retail, or?
It all depends on where we were in the cycle.
Yeah.
So if you remember when you were at the event, and we can get this for your people if they want it, but when Dr. Mueller would talk, okay, where's the office sector in relation to the multifamily sector, so he would go from property type to property type.
Wow. Okay.
So that's when he would sell, out of the multifamily and go into the industrial or go into the office, and, when they weren't favorable to other people.
Right. Yeah. Yeah. No, I love that. Going from popular to unpopular and riding the wave back up.
That's right.
Yeah.
That's right.
Yeah. No, very good. So tell us a little bit more about I know we'll talk a little bit about Robert Heyman and parametrics, but tell us about how you guys connected and how we got to where we are today.
Yeah, sure. So the way, if I go back, I had moved to Denver out of New York City, where I was working actually with a very large family out of Mumbai, India. We had a small team that we had put together, and we were buying luxury hotels and condos in Manhattan between 75 to 450 million. So, that's where I was structuring all the deals. We're looking at them and trying to make good decisions. When I moved to Denver after about a year and a half, I was working with a number of operators throughout the country, and I literally said, I haven't met anybody in Denver. And so I sent out a bunch of emails, and people wanted to meet with me. We just started talking. And at the time, Marcel, who's a patriarch I was talking about that took that million to 600 million, they said, look, we're going to start a fund to bring in outside capital, because when he dies, all his money went to his foundation. And he had all these employees that had helped him build his wealth, and he didn't want them just to be thrown out basically on the street. So they asked me, they said, DJ, what do you recommend for us for this fund? And I said, well, we can go institutional or family office. And I said, let's go family office. And I only knew 2 families at the time. By the end of the year, I probably knew about 150. Today, I know about probably 400 to 500 families. And so from there, I got headhunted by the Heyman family. And then it was just a matter of, finishing up what I was supposed to do after a couple of years. And there really wasn't too much more to do. And that's where I moved over to the Munford family.
And then Robert,
go ahead. Sorry.
Well, just how did that connection and relationship develop?
Yeah. So what was interesting is that Giorgio Beverly Hills and Giorgio Perfume was created by the patriarch. It was a #1 selling perfume in the 80s. They sold to Avon for about $186 million. And one of his sons, Robert Heyman, was actually working in Europe. And I don't know, Forrest, if you knew this story, but he was working in Europe. He found out through the media that the business was sold.
Wow.
So he comes back, he stays on board for about a year, and he thought he was going to take over the family business. Obviously that didn't happen. So he was trying to figure out what he wanted to do. And he started doing some consulting, and he happened to meet Barry Dorfman, and they invested $40,000 in this teeth whitening product called Zoom, which and some of your people know.
Yeah.
And they grew that from $40,000 to $200 million a year in revenues in 100 countries. Sold it to Philips in 2011. And so at that time, Robert, created his own wealth out of that, in addition to the trust he was overseeing, and started buying real estate. So he started buying multifamily, a lot of multifamily, started doing some medical office, some office. And then they wanted to really zone in on that portfolio. And that's when they hired a headhunter who contacted me. And that's how I ended up working for him. And then at the time, as we were stabilizing that portfolio, he started to talk about this device with parametrics, which was, to me, it was fascinating. It was outside real estate. So if I were to explain to you about it, it'd take me probably 60 seconds, and that's my knowledge in the dental industry. But I asked my dentist, and he was like, oh my gosh, yeah, because apparently 98% of the time you can't identify chips or cracks or fractures. And, so I did my best to help him with some of my contacts and stuff. And he's turned that into, continued to expand on that, brought back his same team. And, I believe in what he's doing because he ran the other business. I believe 100% that he's going to be very successful. The one thing I will say, though, that I've learned from all these patriarchs is at the end of the day, they're going to surround themselves with very successful people, and they're going to get their input. But at the end of the day, they will make their decision, and they're going to take it upon themselves. If they fail, they fail, but they're always going to go with their belief that they're going to get it done and make it happen.
Yeah, no, that's great. You've had a a really fascinating career, and I like that patriarch wisdom. That's good stuff.
Well, I plan on, I don't ever want to leave some of the nicest people, and there's just so much to learn from. And, a lot of them, they've gone through the same trials, tribulations as your clients. There was a saying when I lived in Vietnam that the translation was, you wake up one day 28 years later and you're rich, right? Well, when you're working on your business, you're just trying to do everything you can. You're dealing with this, you're dealing with that. And then you look up one day and said, wow, look what I built.
Yeah. Very cool.
And so it's you look at some of these people and it just proves that hard work pays off.
Very good. Well, why don't we let's shift into what's going on in the family office space. Obviously, we're in an unprecedented time in the U.S. and in the world history. What's going on right now with just almost the entire global economic machine grinding to a halt with this coronavirus crisis that's going on. Obviously, there's a lot of fear out there. A lot of people are worried. There's I saw the unemployment numbers for last week was over 3 million applications, which was 3 times the highest it's ever been, which was insane. We're right on the heels of Congress passing the largest relief package, $2 trillion, 10% of our annual GDP. It's pretty crazy, but a lot of fear out there. But tell me, for the families that you're involved with on a daily basis, how are they feeling? Are they worried, or do they have a long-term horizon? Are they really excited about opportunities? Has this affected their investing criteria? Like right now, short term, are they all buying, or are they just kind of hoarding cash and waiting to see where the dust settles? I mean, and I'm sure there's a little bit of all of that, but what are you really seeing?
Yeah, well, the biggest thing was that when you've got everybody has exposure to the stock market in one fashion or another, and that was where a lot of people were really paying attention and noticing it. And the bigger portfolio you have, the bigger dips you're going to see, right? And conversely, so it's a matter of a lot of people are focusing strictly on their equity portfolio. They realize that prices would be coming down, but then you're still stuck with, well, do you sell and then try to buy more at the bottom, or is it going to go back up? What's happening? So a lot of them, there was definitely a concern. That's where they were focused on, and ultimately, at the end of the day, it came down, and it has come down. And this is the majority of families is, they've been saying, let's wait and see. Let's sort of just take the sidelines for a little bit to see what's happening. I think we're already seeing some of that, where people now understand what we're going to go through. We've seen that China is now, they've sort of gotten over the hump, right? And so we can see a light at the end of the tunnel. Now they're moving into saying, okay, well, there's going to be opportunities coming up. So where can we take advantage of those opportunities? But the biggest thing with family office money is that they take a long-term perspective. They don't have to worry about today. They don't have to sell. They don't have to buy. They can hold tight. And one of the things that I remember, as mentioned, I was an advisor in the 90s. Is anytime people would complain about, oh, my portfolio's down and they're all worried, I said, well, you haven't lost any money. Mm-hmm. And or I'd ask them, actually, have you sold? And they're like, no. I said, well, you haven't lost any money. You don't lose any money till you sell, right? And the fundamentals of the economy and what's been going on has been extremely strong. This was just an outlier. So a lot of the families have, like I said, they've been holding try and true. They had been concerned. They're sitting back a little bit, seeing where that opportunity is, and then they'll get right back at it.
Yeah. So let's talk about your favorite commercial real estate. So let's kind of run the gamut, and maybe just talk about where you guys are investing currently, and
Yep.
also, maybe we could just kind of cut down through the asset types and just talk about, what you're seeing and how you think, I think if we look at what's going on, some of them, obviously some of them are getting hammered right now, and then some of them are probably going to get better. And what do you see, starting off with hospitality, because that one's one that everybody's talking about. I mean, hospitality's been getting hammered, but maybe we start there, and then let's love to have your comments on multifamily, industrial,
Yeah.
healthcare, retail, mixed use.
Sure.
I know short-term rentals, and we can get into that. I know you got a lot of experience there.
Yeah. So if we go on the hospitality side, they're definitely taking a hit. And you're going to have a lot of these businesses and hotels that either can't support making those payments, right? And hospitality's been hit the hardest. Same thing with the airline industries, right? And so there's definitely going to be an opportunity on the hospitality side. In fact, I know you had Marco on yesterday. We were actually chatting this morning. We're going to talk on Friday because we're talking about we may put together both of us with both families put together a distress fund to go in. I mean, they've got so much experience on the hospitality side, right? So I would imagine that would be an area that we take a look at.
On the debt side, like buying non-performing loans or distressed loans?
I think that's what we're going to talk about. I think I think you're going to have some non-performing loans for sure that you can step in. Anytime you can get non-performing loans, you're going to be getting it at a discount, right? But you're also going to have some hotels where people are going to be struggling. It's not going to get to that point of not making payments, but they're still going to need they're going to need an out, basically. Yeah. So that's definitely an area. Now, the one thing is that hospitality was doing quite well prior to this coronavirus, and it was actually a great place to invest. And so, that should pick back up once we get going again. Same thing with Airbnb. They're down probably about 20-30% right now. But that should get back on track as well, because once again, the fundamentals were there. Yeah. This is just really taking us back. So hospitality side, there's definitely going to be some opportunity. If they're cash flowing and managed everything properly, they're going to be able to weather the storm, right? But that's going to be the first area. Multifamily, once again, the fundamentals stay very strong. People they're not moving because they're having to stay in place, right? So you're not having people leave. However, you look at a recession-proof asset like a workforce housing. Well, now if they're not working, that's going to be an issue. Now, the stimulus is going to help significantly for that. But what's interesting to note on multifamily is that so real estate will lag behind the market, and then multifamily will have a lag of about 90 days. So because you're not going to know if there's any defaults, people aren't making the rent payments or anything else. So there's actually a lag. So it could possibly happen that by the time that lag would happen and people start not paying the rent, now you're having problems, we're back on track, which is what I think is going to happen. I think things will go back again, and they'll probably say, okay, you got to make up your rent based upon, spread it out over time.
So pause right there for just a second and dissect out I think a lot of our listeners understand the difference, but define multifamily from workforce housing, because, a lot of times people kind of put it into the same thing, but they're really two separate. But how do you split that hair?
So there's really, when you classify buildings, you'll classify them and you'll put a grade to them. So you have A, B, C, and actually D. Same thing for locations. So if you go into any market and any city, you can identify where the A locations are, first off, because it's where the wealthiest people live. You then have B, which is white collar. You have C, which is blue collar, right? So they're working the day-to-day jobs. And then in the D areas, it's lower income, right? And same thing with properties. So a type A would be the nicest building that there is, right? B is it's a nice property. And once again, you have white collar type people that are staying there. And then in the C range, where you have people that are working the blue collar jobs, maybe the retail jobs, et cetera, that's called workforce housing. So that's who's been taking a hit in this, because they're working, a lot of times they might work 2 or 3 jobs, or they're working at the factory or whatnot. So that's the classification of workforce housing. The others that are B are considered market rate. And then on the A is really considered luxury. And then you also have one other category, which is senior apartments, which is typically age restricted, over 55. They don't have services like meals. They don't have, assistance with anything. That gets to a whole nother level. But the senior apartments are like, we don't want kids around. We just want to be empty nesters. Yeah. We're over 55, and that's really where I personally think that's the gap. From an investing in multifamily, that's an area where there's a tremendous amount of opportunity that isn't always spoken about.
You mentioned senior housing, and that's one of the areas that we really like. There's so many different ways of doing that, from the big boxes to the different types of communities, all the way down to the residential models. I'm curious what obviously with the coronavirus, several of these nursing homes and independent living and senior living and memory care facilities, a lot of those were really stricken and shut down visitors. And I mean, I'm sure they're going to be under a lot of scrutiny from just from a safety standpoint, and just making sure that their residents are safe. And I'm curious what you think. I guess short-term and effects of that, and then also, the longer term, any residual effects of that.
Well, that's the population that initially they thought was the most impacted, right? And that has to do with your immune system more than anything. So there's definitely going to be an impact for that. I mean, we've only have the amount of people that have actually died is relatively quite low, right, in relation to the population. I mean, every day, as you know, 10,000 people turn age 65. Mm-hmm. So you can't stop that whatsoever. And it's not like we're losing 10,000 people a day from the virus, right? Yeah. So that's going to continue to be a growing segment. And what the things on the senior apartment side, it's a great, senior apartments are considered recession proof. And the reason why is, I give my parents a good example. We're in our house for 40 years, and I grew up in upstate New York in Syracuse, and they said, okay, we're going to sell our house. And I said, well, where are you going? You spend your summers in Florida or winters in Florida. You're going to go to Florida. You're going to go to the Carolinas. We have a couple of friends. And they said, no, we're staying here. I'm like, well, now why would you want to do that? Mm-hmm. And they're like, because we have our friends and our doctors. Yeah. And so that's one thing. They're going to stay around, which creates a tremendous opportunity for senior apartments in tertiary markets, mm-hmm. which I don't think people necessarily understand. Right. And I looked for an apartment for them. There was only one. They had a 2-year waiting list. And so one of the reasons why they're such good tenants is because after 40 years of junk in your house, they're not going to want to move again. Oh, yeah. Right? So they're in until they go to the next level, which you had brought up, where there's more care that's being provided, right? Once you go from the care and you start going to assisted living, the biggest thing you have to realize is that it's not really real estate in the sense where, just like hotels are an operating business. Mm-hmm. Assisted living is an operating business. So more than the real estate itself, you have to look at who's the operator. Yeah. Same thing with memory care. And then, of course, you have these medical office buildings, which support all of that. Yeah. But that population is just going to continue to grow. Great opportunities. And because of how many people are turning 65 every day or getting older, and we're living longer, there's going to continue to be a demand. Yeah, totally agree. What about self-storage? One of my favorites. Any dent with the coronavirus? You know what? It shouldn't be impacted at all because that's where you're keeping your stuff. In fact, in some ways it could help because people aren't going to be moving as much, right? They're going to
You
keep their stuff in there.
can't go get their stuff. I see.
They're going to get their stuff. What's interesting about that industry is that it's still fragmented. You have a lot of mom and pop owners. There's still the ability to do roll-ups into multiple facilities. You have a lot of the big boys that continued to buy portfolios, and that actually drove the cap rate down, where you couldn't necessarily get the type of yield you were maybe 8 years, 10 years ago. But it's still a tremendous property type, a lot of opportunity because you've got the growth happening into these secondary markets. So that's one, right? As more people move, you got the seniors that are going into these apartments. You also have the millennials that are staying in these apartments. And so there's going to be a continual opportunity there. I think the real opportunity on self-storage, if you don't hope for cash flow, is that you do a roll-up. So you buy maybe 10 or 15 of them, roll them up, sell them off to an institution where you're going to be able to get a premium.
Yeah. No. What about office, industrial, retail?
Industrial, you're going to have really shouldn't see any impact necessarily. They are going to be slowing up on what from a trade perspective, but they should be holding pretty stable for the most part. Retail, a lot of my friends and families, if they had retail, people out of the gate within the first 2 days were asking for rent abatement. And they're saying, look, we're going to need some relief on this. Anybody that hasn't done it, they should do it because they're willing to work. Every owner will work with you on that. You can actually benefit and take advantage of that. It's the service businesses where is really the best place to buy these assets because you can't get your haircut online, you can't get your Starbucks, but because of this, which was unforeseen, those are the businesses that are taking the biggest hit, right? That are salaried employees. It will come back, but it's just going to be tough over the period of time because especially if people are staying in their house, they're going to have to get a haircut more than ever. And so they're going to have that business come back again. The other one you'd mentioned, so retail is getting hit the hardest for sure. And what was the office?
Office.
The biggest area where office is going to take a major hit is the WeWork structure. Because you had people month to month, you had small businesses, and I'm just not going to renew at the end of the month. That's who's going to
work from home.
They'll work from home.
A lot of people will stay working at home. I think
that's the thing, right?
A lot of it. Yeah.
I can do this. I can do Zoom, whatever the case is. So that's where if WeWork didn't take a hit in the past, then this is the time to do it. And I think that, the bigger office space with the larger companies will probably be able to fight through it because they know they're going to have their tenants back. But, I was talking to somebody the other day and another family, and they really believe that what's happening is going to change the face of office for the very fact of what you said, where they're going to realize we don't have to be together.
Right.
We can do a Zoom. We can work out of the house or whatever. So it could really change. That is a sector that could change tremendously going forward.
Let me pause for just a second. Appreciate you guys watching at home and on Facebook and on Zoom. If you guys have questions, please post them to the Facebook page, or you can chat them to us on the bottom of the Zoom line there. If you guys have questions, please post those. Looks like we got a good group on both sides here today.
And Forrest, that can be anything, either real estate wise, it can be family office wise, anything in those two areas.
Absolutely. So jumping back into, let's talk about, we mentioned it briefly, like Airbnb. Interestingly, we have a few Airbnb properties that are on the lake here, and interestingly, where you are, they shut down all the ski resorts because they weren't safe. Everybody was getting sick. Then they shut down the beaches. Everybody was going to the beaches, and then they shut down all the beaches because everyone's getting sick. Well, the lakes have been just blowing up. So anybody else that could go anywhere, like the number 3 on the list was the lake. So like I know our Airbnbs are like totally booked up, and I've talked to a lot of people on lakes in the Southeast, and all of the lakes are really, really busy. But you've got a lot of experience, not just with Airbnb, but also with Sonder, which some of our people may or may not know about. But let's talk about that space a little bit.
Yeah, so Sonder is a company I didn't know about until about 4 months ago, and it's a company that's based out of Canada. They're valued at over $1 billion right now. A couple other companies are coming up. Airbnb actually has invested into a couple of these companies, and it was started by a younger guy who was actually brilliant. He would go and he'd rent apartment buildings, and then he'd put those units on Airbnb. So if rent's $1,000, he's getting $3,000. You know, that's pretty darn good. So their model and the Airbnb in a whole has taken probably about a 25-30% hit. Now we're working on a project right now, which is near the stadium with Sonder. And, you know, we've been waiting to say, okay, are they pulling the plug? Because we know that they're taking a hit on this stuff, and they have released a lot of their employees. But what's been interesting is that we got an email back from their legal department saying, look, we're dealing with stuff in the short term, but we want to go ahead in the long term. Now they're not going to be occupying our space for another 24 months, but that was extremely encouraging in my thought, that they're still taking that long-term perspective. We still want to be able to have all these. We know it's going to be short-term. But what you said is very interesting. I never thought about it, but if you've got to be isolated, you might as well do it in some place that's awful nice, right?
Yeah.
Like on the lake, like you said.
Exactly.
I should have thought about that a couple of weeks ago. But so I guess as long as they fumigate the space, you're okay, right?
Yeah. Well, you're still sheltering in place, but might as well be on the lake.
Exactly. So that shows a lot of promise. I
don't think you're putting yourself at any risk of getting in trouble.
No, not at all. So that's been very promising. I think it just shows that there's a lot of faith in what's going to be happening in the short term.
Yeah. I mentioned on the call yesterday that I thought I was coming up with a good term, but I called it post-pandemic. But after this, I think there will be some things that change real estate. And one of the things that I mentioned, I'll throw it out and see what your thought is. Was just I think that we might have maybe more of a shift towards single family homes away from multifamily to a small percentage. But I think some people might think, well, there's a lot of people there and I want my space. And I think there could be a little bit of pressure towards moving people to, if the numbers were the same, that they might appreciate a home with a fence and versus being in an apartment complex. Just curious if you subscribe to that, and I'm sure it's certainly not going to put multifamily out of business, but I think there's a little fraction there that of people post pandemically that will be thinking that way. What do you think?
I know the space very well, and I don't think I ever told you this, but when I got back from Asia in 2003, I said, what do I want to do? I put some private money together, and I actually started what was going to be the first single family REIT. So I was about 10 years ahead. So build up a portfolio of single family homes, the whole deal.
Yeah.
And then I sold it off before the downturn.
Good.
But
how many homes did you have in the portfolio?
Oh, we had 100 plus. And what the reason why I backed out is because in the 90s, when everybody was becoming a stock picker, I was like, okay, now people are. This is eerie. I've seen this movie before. Now everybody's a developer, right? Yeah. And one of the first books I read was Timing the Real Estate Cycle, which was with Craig Hall out of Dallas. It's a very easy read, but it was awesome, and it really went in. That's one of the many books I would highly suggest. And so I sold off the portfolio, but how I sold them was I packaged them as a multifamily. I didn't package them selling them one at a time. Basically, this is your portfolio. But You could be right in the sense where if people are in a little, if they're sheltered in place, truly, they're going to be cramped in a little space, and they're going to I want more space.
Yeah.
Right. That's when in New York, when people would leave the city, it was because either family, kids are growing up, or I can't handle living in this 900 square foot apartment anymore.
I tell you, I think there's some people that probably would really appreciate a backyard where you can go into your backyard versus if you're in an apartment, man, you're stuck there.
Oh, 100%. I mean, we sat out on our front porch yesterday, hadn't been able to for a long time because we got hit with another 6 inches the other day, believe it or not. We're east of the mountains. But it was great sitting outside on our own place, So I think you could be right about that. I think that a lot of people they're definitely they'll have plenty of time to do some thinking, right?
Yeah. Yeah. You want to comment on do we leave anything out? I don't know if you want RV parks or student housing or anything
RV parks.
Else, anything else you want to mention?
Well, student housing is going to take a major hit. None of the students are going back.
I think colleges are going to take a major hit, and by extension, I think student housing is going to take a hit.
You know what? That's a very good point. I hadn't really thought much about it, but just from and also I think what's going to come up, and we were talking about this the other day too, is that all these students, even high school students, are doing stuff online. My son said to me yesterday, he's a senior, he goes, it took me 3 hours to do my homework, whereas if I was at school, I'd be there for 7 hours.
Yeah. Yeah.
Right. And so of course he likes that because he's not spending all day doing nothing. But I think they're going to find out a lot of universities are going to be taking a hit because you can do this online.
Yeah.
And a lot of them too were these universities were prorating what they were paying for on-campus housing in the dorms.
Yeah.
So all of these they're going to try to hold to the leases, that the students have. But I think there's going to be definitely a fallout. I think it's definitely going to be a market to look at for sure. I think you bring up some very valid points.
Yeah, I think go ahead. Sorry.
No, I was just going to say I on the rent or RV parks. Huge. That is a great area. I did some consulting when I lived in Massachusetts for a couple of months with a firm, and I went in there and I didn't realize at the time, but all the homes were purchased, and there's two types. There was your actual trailers, and then they had modular, basically, that was on a flat slab, and people owned those, and they were renting the land, getting like $400 or $500 a month, which there's really not much to do, right? Yeah. But in general, we have an affordability problem, and and they cash flow tremendously. Yeah. So if you can find a good one, then they're definitely it's a great place to be, and I think long term you're going to be in pretty solid shape.
Yeah. No, I agree with that. I wanted to go back to the colleges for a minute there. I just had another comment there that I know most of my people know. I've got a son who's in college and a daughter who's finishing up high school, and they're both at home sheltering with us, and they're taking their online classes. And my son has done it before, so he's really good at it. But I think there's going to be a whole portion of these students now and into the future that go, what, online courses isn't so bad. If I took they're going to end up, almost all of them are going to end up taking at least a semester or quarter of online classes. And I think there's a lot of them that are going to go, what, this is not so bad. I could work and get my classwork done. And I think this is, just for the same thing we talked about, the WeWork and people working from home. I think students are going to work from home. And I think ultimately that's going to tie into the college debt bubble crisis. That maybe this is part of the answer. And students are taking more online classes and maybe fewer on-campus classes, and that's going to hurt the colleges. I think this whole thing is going to hurt their colleges.
Well, a lot of people have been moving toward community colleges, which are definitely having an impact. People are starting to go more toward the different trades where they can learn, right? Who was it? Elon Musk, I think, came forward a couple months ago. I don't know if you knew this, but he's like, I don't care if you didn't even graduate from high school. If you're good, we'll hire you.
Yeah.
Right. And then they're going to come in making a couple $100,000. So
Yeah.
it's really what they know. You know, on the university side, the only downside I would say is, at least from my experience, is that you have a lot of the millennials, and we'll use that term for a while, and then probably get some people smiling at this, but they don't want to pick up a phone. They want to text everything, right?
So
And it's all about relationships, and that's one of the things that you get when you're in college. If you're at the college, it's the interaction, right? It's the growing up, it's the going to the parties. I mean, that's a huge part of that education. And the only thing is that right now they're texting. So if you put them all online, you're actually creating more of a problem, you know? In fact, it's funny because Kenny is a millennial the third gen, and we were working on a project with a couple other millennials. And we're working on a transaction, which is up north, you know, with the 7-Elevens and stuff. And we're talking this morning. I'm like, yeah, well, make sure you pick up the phone and call them. And they're like, no, we'll just text them. We'll email them. I'm like, oh my God.
Yeah.
So I think it's going to help financially. I think it's going to help with the student loans, but I do think universities are going to have a problem.
Yeah. Yeah. Well, why don't we, you mentioned the project up north. Let's talk about single tenant, triple net lease, because I know that's something that you guys are really involved in. Let's talk about that space. And then maybe we'll even talk about, I know you and I are talking about potentially doing a deal together right now, which could be a live investment opportunity for our community. So let's talk about the space first and how that works. And then we can talk a little bit about that specific deal.
Yeah. So the triple net area is something that's extremely favorable on a number of sources, or a number of ways. First off is that, so we're buying 27 more 7-Elevens. We'll be the second largest owner of 7-Elevens in the country. We also own a number of Jersey Mike's. We own some Taco John's. And when you're dealing with a franchise like a 7-Eleven, you have a very, very, very good credit rating. And so you've got the credit agencies, which are ranking how good of payers are they, right, on their loans and everything else. Whereas an apartment building, you can't do that because it's all individual tenants, right? Mm-hmm. You can do it if you have an industrial property and FedEx is the tenant. You feel pretty safe that they're going to make their payments, right? Or a Walgreens type deal, because they've been around, they're very large, et cetera. And so they get credit rating. And so what happens is that banks will love to lend, and they'll do it at very favorable rates. And you'll get a lot of people that want to buy these that have a 1031 exchange, money from the sale of another property, and it can create long-term income, right? Mm-hmm. So and the leases are long. So you might have a 20-year lease that okay, it's one tenant, they're taking care of the taxes, the overhead, the utilities. There's really no management into it for the most part. And you're just going to keep clipping checks, which is tremendous, right? Because not only are you getting the checks for your income to help supplement, whether it's Social Security or something else, but you also have that appreciation. And the values of these locations will go forever. In fact, the one gentleman that you were asking me that I worked for that turned $1 million into $600 million, when he sold 80% of his portfolio, he moved the majority of all that money into Walgreens. He was the largest owner of Walgreens because during the downturn, people still need medicine, right? It's one of the essentials that they've kept open. So these are very favorable.
That to the listeners, like that, how he would own the building and he would lease it to Walgreens, and they would pay for everything. So what does that look like financially for like owning one Walgreens? I mean, what kind of return is that for one store?
Yeah, so Walgreens owns only 20% of all their buildings. So and the average building size currently is about 14,000 square feet. Same thing as CVS. Mm-hmm. So they'll say, we're going to go in, our business is pharmacy, where they make 70% of their revenues, and the rest are selling things that we might pick up, soda or, other ancillary things. Yeah. And so that's where our business is. They're an operating business. And so we're just going to rent the property. But we want to make sure we got a great location. So we want to make sure that we're going to be sitting on this corner forever. We don't want CBS coming in. So they're going to sign a loan for about 20 years. And so what happens is that initially you might be getting a 6% return on your money that you invest. And they're taking care of property taxes. They're taking care of all the utilities. They're taking care of any fixes that need to be done on that property. So you're not having to worry about that. And for providing that building to them, which you own, one building with one tenant, you'll be getting probably 6%, let's say maybe 5.5% you start. The longer you hold it, that's going to go up. So now you'll go to 7%, 8%, probably about 9-10 years down the road, you're going to be making double digits on a company that is, might have a AAA credit rating or an A- credit rating. And so you can identify who's a good tenant and who's not. So it's ideal for long-term income. If you sell a property, you're tired of managing it. Let's say you go and you sell all your single-family homes. You're like, I'm done. I want nothing to do with it. I'm going to move that money and buy a couple Walgreens, and now I'm just going to clip coupons, basically, for that revenue to come in. And what's great, too, is that if you wanted to go sell it one day, there'll be people lining up at the doorstep saying, I want to buy it.
Yeah, wow.
Because they know that it's a continual, payment stream. And so that's
what. By the way, all the Walgreens are still open right now. So
they're all open.
Pandemic proof.
Yeah. Well, what's interesting is that the 7-Elevens are maintaining. There's really no dip because people will come in, maybe buy some food, and they're going to get gas if they're out and about. Mm-hmm. So they're not really seeing any impact. It's the Subway, it's the Taco John's where they're seeing some of that. So back to what we were talking about. So one of the strategies that we've been just operating the 7-Elevens. It's been strictly on the operation side. And now we formed a business where we're just going to, we'll build those. And we'll have another entity that will own all those properties. Mm-hmm. And I've been driving that, to be honest with you, because I don't want to deal with the day-to-day. I just want the asset, know who's paying. So we're adding Walgreens to that. I went to the president, pushed me down to the CFO, and I went with a new strategy for them, which they're actually implementing right now. So we're going to look to do some of those. We've got relationships with Starbucks, Chipotle, of course, 7-Eleven, and a number of other, large companies. And so one of the places with what's been happening with the volatility is we actually have the ability for a piece of property up north outside Denver, great demographics, 27 acres. It's worth about $7 million right now. And we're going to put initially a 7-Eleven, and then we'll have 4 other locations, one for a bank, one for a Starbucks or Dunkin' Donuts, and a couple others. So, the one thing when you build and what people don't realize, we build for the 7-Eleven corporate, they're going to guarantee it first off. Yeah. And on the development, you could have a buyer before you even break ground, and we can give you, like, example, if we had partners, we could give you a 20% return all day long on that, and we'll pre-sell it. Yeah. And so we've got one of those opportunities we're working on right now, where it's actually, we're going to secure the money. It's about $1 million against the land of $7 million. It's only a 15% loan to value. And to be honest with you, I'd want to take over the land if I invested in there. But the person in the second position won't let that happen. And then Kenny's got a personal guarantee behind that. Yeah. But that'll allow us to go into 7-Eleven, and then that'll be sold before we even start. And then we'll go to the next Starbucks, and we'll go to the next location. And you can actually 1031. Do you guys do a lot of 1031 exchanges?
We really haven't done a whole lot, but yeah, we've got we do have some clients that have been doing that over the last few years.
So in this situation, what can actually happen, and this is why the 1031s are so important, is that let's say you're getting a 13% return for this bridge for just 4 months. If you converted that into the equity, into the 7-Eleven, which is like a AAA rated, right? It'll get sold immediately. You go from 13%, where we could lock in a 20%. if you take that money and you 1031 into the next deal, your 20% automatically goes to 24.5% that you're investing because you're deferring those taxes.
And any taxes on it.
And that's where, my principal, he had $250 million because he just kept rolling it forward. And if you die, that there's a step-up basis.
Step-up basis to that.
Which is tremendous. So if you like paying taxes, don't worry about it. If you don't like paying taxes, then that's a great opportunity.
So I'll just say I've got the details on that. So if you guys are, if you're watching here or if you're watching on Facebook, this is just for our community. So if you'd be interested in learning more about that, let me know. I got DJ and I are working on putting that together now.
And if they participate, they can say they're investing next to the owners of the Rockies.
Yeah, that's
and
cool.
I'll also get them tickets. And tell me anytime you come to the game.
And we're all in now. We're all in. And actually, I guess before we move off of that, really great area too, because I know the population has just been blowing up in Denver, and this property is just 30 minutes north of Denver. Is that right?
It is. It is, and there's been a huge amount of growth going up to Fort Collins, and it's right on the artery going up.
Yeah.
Income levels are serious. It's one of those where it's great where you can still go into Denver for work, or you can still be outside. The University of Northern Colorado is up there too.
And the plan is, are you putting on the 27 acres? How much of that's going to be developed into triple net lease retail?
Yeah, so we're going to do 5 pads. So 4 of those are going to be triple net, like the 7-Eleven, Starbucks, Dunkin' Donuts, Chipotle, and then we're going to put a bank on there too. So we'll have a major bank, and then we're actually carving off 5.5 acres for probably about 250 multifamily units, which we'll be doing. And then also we'll have an extra space available that we've got to identify what's the best use for that land. But one of the conversations we're looking at is possibly self-storage.
Yeah.
Because there's just been so much growth up there.
Yeah. So much opportunity there. Yeah. That's exciting. Before we've got some questions coming through. So before I get over there, let me, DJ, if you were a doctor or dentist right now, you're one of our listeners, and you got you own your business, and your business is closed right now, and you got a net worth of $3-4 million, and you got a staff of 20 that are depending on you. What are you thinking right now? What are you doing? What kind of opportunities would you be? What would be going through your mind? You're trying to put yourself in the in the seat of where a lot of our clients are.
Well, the first thing I would do is I'd take a look with what happened today to say, how can I take advantage of maybe one of these stimulus plans, right? If I can pay my people, they've been there for me, they've helped my business. If I can lock them in for a number of months, that's the first thing I do. And then I would, and probably if they're getting paid, I don't imagine they have to go into the office. Sort of like a paid vacation, right? I don't know, because they still need to stay in place. So that would be the first thing. Second thing is that I would see if I had any liquidity available whatsoever, and I would look for opportunities because prices are down and opportunities are going to be plentiful. Hard assets is going to be a great place to be. And we've got a lower interest rate environment, and we also have we're going to lower some of the construction costs because a lot of the contractors are going to be looking for business. So hard assets are great. It's not going anywhere. And then I would take the attitude that if I actually have some time available, that I'm going to sort of reboot my batteries, maybe start planning for what I'm going to do in my next phase of the business that I haven't had a chance to do because I've been just in the business instead of on the business. Absolutely. So it creates a great opportunity to work on the business. It's also a great opportunity to reconnect with the family, whether it's your spouse, your significant other, or your kids, right? And so I would be doing that, but also be prepared that you're going to have to turn on, that switch again, because you're going to be going at it sooner than you realize.
Yeah.
And so you better, now's the time to rest up and be ready, because people, whether you're a doctor, dentist, whatever the case is, they're going to be like, okay, I got to get back in. I got to see you, and they're going to be super busy.
Yeah,
It's
yeah,
going to
it's
be
funny.
a pent up demand.
That's a great point, and I've got a message from Miss Carol today for all of the dentists on the call. She said, "Don't you guys worry. Everybody's at home right now. They're eating candy all day. They're going to have lots of dental work that they're going to need to do when you guys open back up." So
yeah, they got to get back.
There is
They
a
got to
big
be.
pent up demand for sure.
There's going to be pent up demand for sure, and it's going to come before we know it. I mean, I don't think it's realistic in the next 2 weeks that we're going to, open back up again, but it's inevitable, and it's going to come pretty quick.
Yeah, no, that was good. 100%. We're right in line with what we've been preaching. Recharging the batteries, focus on the business, be visualizing what the grand reopening looks like, be planning for new services, for things that you guys can be doing, working on the business, working on the family, working on your investments and your financial plan. That's really good.
Well, that's the other thing too. And the other thing I'll just mention that you maybe think of is, let's say you don't have a program that you're consistently keeping in touch with your people or your customers, right? Maybe now's the time to do that, to set up, because there are programs, relationship management programs, that you can write 12 different emails, just little emails that you put on autopilot that automatically go out, right? So, and I also think that this time is a time to think about, okay, what are other revenue sources? Or what else can I do to let's really dive into our expenses. Where can we cut our expenses? Where can we improve the business? Because you just haven't had time over the years.
Yeah, no, totally right there with you. Let's see, I got a few questions over here. Let's see. Let me see. So Gunter's on the call. Okay, so Gunter asks, Todd and I are working with some family offices to line up some money to buy opportunities coming in the commercial real estate market. What is DJ suggesting for the best asset classes to look at?
That's a good question. I would say that, well, hotels, but that's an operating business. There's going to be some opportunity there. I would say on some of the smaller multifamily, and if you can find out some of the debt that people are going to have a challenge for, the key spot, I would say, depending on how much money you have, it's always in that $5 to $10, $12 million range, maybe even $3, depending on where you're located. It's in the middle of nowhere, right? It's a little bit more than country club money. Family offices can help with some of that equity that's needed. So I would say look for properties like that. I would also say, I think it's going to be, you're going to have people that have been over leveraged for sure.
Yeah.
And I think long-term multifamily, I would see if you can find some of those opportunities. I would also talk to some debt providers, mortgage brokers. They're going to know who's having problems. And a lot of deals are going to be falling out. Land would be a great place to buy. I really believe that, because land's what drives everything.
Yeah.
It's all about the land. So if you can get some land in a good location, then that'll definitely help.
Yeah.
I wish I could be more specific, but it's really a short-term downturn we have. It's not like it's been 2 years.
Sure.
So I would have to say you just got to really look for value regardless of the property type.
Yeah, no, very good. Let's see. So why don't we
Single-family homes could be an area, by the way.
Say it again.
Single-family homes could be an area.
Yep.
Because let's say that they're not making payments, or maybe they had a bunch of Airbnb stuff and they can't fill it.
One of the things that I've been talking about is just, and we've been doing this really, and I've said this probably for the last year, is shifting more over to the debt side, either on the private lending side, and even non-performing loans, and some of that in the commercial space. So that area is really, it's thinned out some, but I think there's going to be a lot of opportunities in there. And I know we've been talking with quite a few people even before this happened to look into to that debt
Now,
side. So I really like that in the upcoming future.
Well, I will tell you this, and I'm on, and I've been on. I've said this at conferences, online, podcasts, the whole deal. We're not going to see an actual recession until about 28, 29. They run in 18 and a half year cycles. If we look at 2012, when we came out of this, you're looking into 2019, you usually see about a 6 to 9 month dip. And then the next 7 years is greater than the last 7. So the only thing that I would say is once we come out of this virus, which was anomaly, right? It wasn't part of a typical situation. Make sure that you don't miss out on some of these opportunities where there's going to be a tremendous growth coming forward. And then that's when you really go into a cash position, probably around 2027, 2028. And then that's where the real wealth is made.